Good evening and welcome everyone. Wish you all a very happy new year. We have on the call Rajiv Anand, Deputy MD, Subrat Mohanty, ED, Manish Sharda, ED Designate, of course Puneet Sharma and other members of the leadership team. Over the last few years, we have set Axis Bank on the course of a predictable and sustained high performance guided by a GPS strategy, which is centered on our customers and our colleagues. We had the opportunity to highlight our execution rigor, distinctiveness and differentiation at our Analyst Day in November 2023. The Indian economy continues its upward momentum in Q3 and remains a beacon of optimism globally. A mix of judicious and bold policy moves has placed India in a sweet spot, which bodes well for the sector in the medium term. In Q3 financial year 24, we in Axis delivered strong operating performance led by robust sequential growth across loan and deposits. Let me briefly highlight them. The bank has delivered an ROE greater than 18% for the last 6 quarters now, while maintaining a better credit profile as compared to the past, instilling confidence in its sustainability across economic cycles. The bank has organically net accreted 39 basis points of CET1 capital in 9-month financial year 24. On loan growth, all the 3 segments delivered strong sequential growth, with retail, SME and corporate book gross of IBPC sold growing 5%, 4% and 3% quarter-on-quarter respectively. On deposits, we have improved the quality of our granular franchise significantly, with our LCR outflow rates and CASA ratio being the best in class in the sector today, and our retail term deposit growth improving to 12-quarter high. On cards and payments, we saw strong traction in new card issuances, cards in force and spends led by our strategic partnerships. On the merchant acquiring business too, we have now attained leadership position with terminal market share of close to 19% as of November 23, with widespread adoption of our innovative technology-based product offerings. On digital and technology, Open by Axis continues to be the highest rated mobile banking app with a rating of 4.8 on the Google Play Store. On the iOS App Store as well, Open by Axis rating has increased to 4.7 this quarter from 4.6 earlier. Neo, our cutting-edge digital product offering for corporate and SMEs, is deepening our transaction banking relationship amongst clients. Axis Bank has been recognized in the highest leadership category with score of 77 in the Indian Corporate Governance Scorecard, recently published by Institutional Investor Advisory Services, with a evaluation framework built around globally accepted G20 OECD standards and principles. We have tried to be ahead of the curve towards building a bank for the future with deep investment of management time and resources in our chosen areas of distinctiveness, namely digital, Bharat banking and customer obsession. We stay focused on 3 core areas of execution of our GPS strategy, namely embedding a performance-driven culture, strengthening the core and building for the future. On embedding a performance-driven culture, there is visible improvement in the retail deposit growth and the quality of our deposit franchise. The growth trajectory of retail term deposits continue to improve with 17% year-on-year and 2% quarter-on-quarter growth on period end basis and 15% year-on-year and 3% quarter-on-quarter on QAB basis. Our low-cost CASA share at 42% is among the best in the industry and has compounded at 14% for the last 3 years. In Q3, we added 100 branches, taking the overall branch additions to 349 for the 9 months period for financial year 24, which is among the highest in the industry. Further, we are doubling down on our deposit mobilization strategy led by 2 large transformation initiatives, Siddhi, which is a super app for our employees, and Project Triumph. We spoke about them during the Analyst Day. We have enabled every business vertical and channel through tools and platforms like video-based customer identification process, bring your own device and Siddhi app to serve our customers real time and onboard new customers with minimal friction. We have a strong foundation for our liability franchise. We continue to work on the deposit leadership roadmap we set a year back, and we expect to realize the full potential of this transformation in the next 6 to 7 quarters. We are also seeing all-round growth across businesses. We have market-leading growth in our focus segments, while within retail lending, we continue to drive balanced growth across the product portfolio. The retail disbursements in Q3 financial year 24 were the highest ever for a non-financial year closing quarter, aided by improved customer sentiments and strong festive demand. Domestic corporate loans, gross of IBPC sold, grew 23% year-on-year and 3% quarter-on-quarter, led by a healthy pickup across sectors. The disbursement pipeline for Q4 continues to be healthy. And the SME segment continues to remain a key growth driver for the bank. The combined portfolio of mid-corporate SMEs and small businesses grew 30% year-on-year and 5% quarter-on-quarter, and now constitutes 21% of the loan book, up 620 basis points in the last 3 years. On strengthening the core, on wholesale banking, we have replicated the success of our digital consumer banking app with Neo for corporates. We have been on this journey for 2 years, and we now have a validation for the strong product market fit based on how quickly our clients have embraced it. On transaction banking APIs, we continue to see strong interest from corporates across industry segments, with 3.7 times growth in corporate onboarding, along with 7 times growth in transactions and 4.8 times growth in throughput. Neo for Business, our mobile-first transaction banking platform tailored for SMEs, continues to scale up in terms of customer onboarding. We saw an increase of over 25% in digital usage amongst these customers with the introduction of business banking specific features. We are in the process of rolling out a host of beyond banking features, which will include things like ERP integration, payroll, and inventory management. We have also rolled out Neo for Corporates, our internet banking proposition for large corporates, to all new customers, and we are in beta testing with existing corporate clients. With full rollout of Neo, Axis remains on track to become the operational bank of choice for our wholesale banking clients. As far as building for the future is concerned, digital banking performance continues to remain strong. The Open by Axis Bank balance sheet has an increase of 48% in deposits and 86% increase in loans. We launched a new digital savings account proposition, Amaze, that provides customers attractive joining offers and spend-based rewards for a nominal monthly fees. We also launched and scaled new products, including FD for standalone credit card customers, US dollar FDs and Gift City for NRI customers, and new loan and insurance products on Open. Our bank-wide programs to build distinctiveness continue. Our bet on Bharat banking is growing from strength to strength. The Q3 financial year 24 disbursements are up 46% year-on-year. Rural advances are up 34% year-on-year, and deposits from Bharat branches are 11%, thereby aiding the PSL and profitability metrics. We have expanded our multi-product distribution architecture to 2,420 branches, complemented by 63,500 CSC Daily network and 80 partners across the industry. Our digital co-lending platform is live with 10 plus partners, and the volumes are growing 80% plus quarter-on-quarter. We are building a pioneering end-to-end omni-channel and digital delivery model for the RUSU markets using the Salesforce platform. This will help us scale sustainably over the next 3 years. Sparsh, our customer obsession program, is helping improve relationship and transaction intensity with our customers. Over the last 21 months, NPS across 12 retail customer journeys has moved up to 141 over an index baseline of 100 as we listen to and act on the voice of our customers. NPS is now an important lead indicator for us to invest in areas that matter to our customers. Sparsh is a bank-wide priority. It is embedded in rituals and practices across all the 5,250 plus branches, all our customer touch points, and in the conduct of every employee. On Citibank consumer business integration, the Citi integration remains on track with acquired business portfolio metrics trending in line with internal estimates. Deposits are stable, and there has been improvement in cross-sell matrices across wealth, insurance, and retail assets. Nearly all the 70 synergy initiatives that were identified across cross-sell, deepening, sales productivity, and cost rationalization remain on track and monitored by the board. We expect to complete data migration and system integration by end of first half financial year 25. In closing, the growth momentum in India continues to be strong. We have taken global headwinds and higher interest rates in our stride. Consumer sentiment remains healthy with improved capacity utilization across sectors for corporates. The factors are ideal for an uptick in private capex. The deposit growth in the system is a challenge with a tight liquidity environment. We expect this to continue till inflation reaches the lower bound of the range. We foresee the system credit growth to converge towards deposit growth of around 13%. We see this as an opportunity to differentiate and serve our customers better. All of us are building an all-weather institution that will stand the test of time. I will now request Puneet to take over.
Thank you, Amitabh. Good evening, and thank you for joining us this evening. We continue to make good progress towards building a stronger, consistent, and sustainable franchise. The salient features of the financial performance of the bank for Q3 FY24 across operating performance, capital and liquidity position, growth across our loan and deposit franchise, asset quality, restructuring, and provisioning is as follows. Our operating performance for Q3 FY24 was steady across NIMs, cost, and credit cost lines. Consolidated ROA at 1.84%, consolidated ROE at 18.61%. Subsidiaries contributed 9 basis points to consolidated annualized ROA and 54 basis points to consolidated annualized ROE this quarter. The bank CET1, including profits, stands at 13.71%. Organic CET accretion in 9 months FY24, including profits, was 39 basis points. Change in regulations impacted CET1 by 70 basis points. COVID provisions translate to a cushion of 43 basis points over and above the reported CET1 ratio. Our net interest margin for the quarter was 4.01%, declining 10 basis points Q1Q. Yield on interest earning assets improved by 69 basis points YOY and 6 basis points quarter on quarter. This increase was offset by increase in cost of funds, thereby impacting NIMs. We have always maintained that NIMs should be looked at on a full year basis. For 9 months FY24, NIM was 4.08%, better than 9 months FY23 by 13 basis points. NII was at rupees 12,532 crores, growing 9% YOY, 2% sequentially. Fees at 5,169 crores, growing 29% YOY, 4% sequentially. Our granular fee is 93% of our total fee. Operating profits stood at 9,141 crores, growing 6% Q1Q. Core operating profit at 8,850 crores, grew 1% quarter on quarter. Cost to assets at 2.49%, increased 25 basis points YOY. Net credit cost at 0.28%, improved by 14 basis points on a Q1Q basis and 37 basis points YOY, aided by higher recoveries and an upgrade of a large corporate restructured account. PAT at 6,071 crores, increased 4% quarter on quarter. GNPA at 1.58%, declined 80 basis points YOY and 15 basis points Q1Q. Net NPA at 0.36%, declined 11 basis points YOY. Our standard asset coverage ratio is 1.29%. All provisions by GNPA stood at 153% at 31st December 2023, improving 1,385 basis points YOY. We achieved the financial closure of the Citibank transaction. We request you to refer Note 6 of the UFR for details. There is no material impact as the transaction was fully accounted for in FY23. We remain on track to achieve LD2 per earlier estimated timelines. Our progress on structural NIM drivers continues well, with improvements across all variables on a year-on-year basis. Improvement in balance sheet mix, loans and investments comprised 89% of total assets as at December 23, improving 154 basis points YOY. INR denominated loans comprised 95.8% of total advances, improving 250 basis points YOY. Retail and CBD advances comprise 69% of total advances, improving 264 basis points YOY. Low-yielding RIDF bonds declined by 8,170 crores YOY. RIDF comprised 1.8% of our assets as at December 23, compared to 2.73% of our assets at December 22. Quality of liabilities measured by outflow rates improved by 600 basis points over the last 2 years. Given the liquidity and rate situation in the market, average CASA was 42%, declined 196 basis points YOY. However, this continues to be amongst the highest in the private sector bank space. We had good fee performance in the quarter. Total retail fee grew 36% YOY and 6% Q1Q. Fee on retail loans grew 26% YOY, 7% on a sequential quarter basis. Retail card fee grew 58% YOY, 12% Q1Q. Commercial card fee grew 35% YOY, 10% Q1Q. Fees from our third-party products grew 42% YOY, 4% Q1Q. And our commercial banking business fee grew 13% YOY and 6% Q1Q. Trading profit and other income at 385 crores was lower by 178 crores YOY and grew by 314 crores sequentially, mainly on account of better DCM and trading performance and reversal of MTM booked in previous quarters. Operating expenses for the quarter was 8,946 crores. growing 32% YOY and 3% sequentially. It is pertinent to note that there is no Citi BAU expense in Q3 FY23. Integration expenses contribute 4% of the YOY growth in operating expenses in percentage terms and 13% of YOY cost growth in rupee terms. The balance YOY increase in rupee crores of expenses other than above can be attributed to 10% linked to volume, 47% technology and growth related investments, and 30% from our BAU activities. Technology and digital spends grew 36% YOY and constituted 9% of our total operating expenses. Staff costs increased 19% YOY. We added 12,075 people from the same period last year, mainly to our growth businesses and technology teams. We've opened 350 branches in the 9 months FY24, with 100 branches being opened in Q3 of FY24. Q1Q increase in operating expenses is largely attributable to higher volumes. Provisions and contingencies for the quarter were 1,028 crores, lower by 28% YOY, but higher by 26% Q1Q. Adjusted for the prudent provision made for AIF investments, provision and contingencies for the quarter would be 847 crores, flat quarter on quarter. The bank has not realized any of its COVID-19 provisions, and this provision is entirely prudent. The cumulative non-NPA provisions as at December 31st, 2023 stood at 11,981 crores, comprising 5,012 crores towards COVID-19, restructuring provision of 587 crores, including unsecured retail being provided at 100% and the rest at first bucket NPA rates, standard asset provision at higher than regulatory rates of 2,216 crores, weak asset and other provisions of 4,166 crores. Moving to growth across our liability and loan franchise, we gained 20 basis points market share on a year-on-year basis across our deposit and loan franchise. Please refer slides 19 and 20 for details around the quality of our liability franchise and slides on our loan business. The bank sold IBPCs in the current quarter aggregating to 5,754 crores. Grossed up for IBPC sale, the QOQ loan growth was 4% and the YOY loan growth would be 23%. Total deposits on a QAB basis grew 18% YOY. Our CASA ratio on a QAB basis grew 13% YOY and 1% sequentially. Our loan book is granular, well balanced, with retail advances constituting 59% of overall advances, corporate loans at 31% and CBG at 10%. 69% of our loans are floating rate. 48% of our fixed rate loan book matures in the next 12 months. Breakup of the floating rate loan book by benchmark type and MCLR repricing frequencies set out on slide 11 of our investor presentation. Our retail advances grew 27% YOY and 5% sequentially. 75% of the book is secured per internal classification. Q3 FY24 retail disbursements grew 47% YOY and 10% sequentially. Unsecured disbursements were 22% of retail disbursements for the quarter as compared to 25% in the previous quarter. Disbursement growth in home loans was 37% YOY, small business and auto loans 33% YOY, retail agri business 46% YOY, and personal loans at 61% YOY. Moving to our wholesale banking business, details of rating composition, incremental sanction quality is set out on slide 36 of our investor presentation. The domestic corporate loan book grossed up for IBPC sales grew 23% YOY and 3% Q1Q. The offshore wholesale advances are largely trade finance related and primarily driven by our GIFT City branch. 95% of the overseas standard corporate loan book is India linked and 91% is rated A- and above. The commercial banking book grew by 26% YOY and 4% quarter on quarter. The quality of the CBG franchise we are building and the strong relationship-led approach is reflected through CBG new to bank book growing by 28% on a year-on-year basis, and 84% of our CBG loan book is PSL compliant. Moving to the performance of our subsidiaries, detailed performance of the subsidiaries is set out on slide 69 to 77 of our investor presentation. Domestic subsidiaries reported a total 9-month FY24 net profit of 1,108 crores, growing 17% YOY. The return on investment on domestic subsidiaries was 50%. Axis Finance Q3 FY24 overall assets under finance grew 38% YOY. Retail book constitutes 44% of total loans. 9-month FY24 PAT for Axis Finance grew 25% YOY to rupees 425 crores, and Axis Finance has a healthy CAR of 18.79%. Axis Finance's strong asset quality is reflected with a net NPA ratio of 0.32% and negligible restructuring. Axis AMC overall quarterly average assets under management grew 6% YOY to 2,62,398 crores. 9-month PAT stood at 297 crores. Axis Securities broking revenues for 9 months grew 42% YOY to 757 crores, and PAT grew 31% YOY to 198 crores. Moving to asset quality, provisioning and restructuring, asset quality continues to improve. The slippage, gross NPA, net NPA and PCR ratios of the bank and segmentally for retail, CBG and corporate are provided on slide 60 of our investor presentation. The bank has made investments in AIF aggregating 207 crores, details of which are as follows. 46% of the AIF investments are in AIFs that are directly or indirectly government owned or from sponsoring entities like NIIF, NABFID and NABARD. The bank has not invested in any single AIF amounts greater than rupees 50 crores. The portfolio overlap in AIFs is 85% A- and above rated exposures and 15% AAA rated exposures. The realizable value at 31st December is close to the holding cost of the investment. The bank has prudently provided 100% of its entire AIF outstanding, agnostic of overlap as on date. Net slippage ratio annualized stood at 0.5%, declining 43 basis points YOY and 9% Q-on-Q. Net slippages for the quarter were 1,117 crores, declining 35% YOY and 12% Q-on-Q. Net slippages segmentally were 1,988 in retail, 74 in our commercial banking business, and negative 945 crores for our WBCD business. Recoveries from written-off accounts for the quarter were 635 crores. Net slippages of the quarter adjusted for recoveries from written-off accounts was 482 crores, of which retail was 1542. Our CBG business was a negative 11 crores, and our WBCD business was a negative 1,049 crores. For the quarter, 35% of our gross slippages are attributed to linked accounts of the borrower, which were standard when classified or have been upgraded in the same quarter. To summarize the performance for the quarter, Axis Bank is progressing well to be a stronger, consistent and sustainable franchise. This is visible through organic CET1 accretion of 39 basis points for the 9 months FY24, our COVID buffer of 43 basis points of overall capital adequacy, our overall coverage at 153% of GNPA, and limited restructuring of 0.16% of our gross customer assets. Consolidated ROE for 9 months FY24 was 18.86%, 82 basis points higher than 9 months FY23, an outcome of disciplined execution. The bank has ample and sufficient liquidity visible in an exit LCR of roughly 129%. Given the increased focus on the CD ratio as one of the multiple metrics to be tracked, deposit growth would be a key constraint to growth in advances in the short to medium term. We are well placed in the current macro environment. We continue to closely monitor geopolitical, inflation, liquidity and cost of funds that impact our business. Thank you for your patience. We would be happy to take questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. An operator will take your name and announce your turn in the question queue. Participants are requested to only use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Chintan Joshi, individual investor. Please go ahead.
Hi, this is Chintan from Autonomous. Before I ask, can I just quickly get your LCR deposit number for reference? And then the question I have, your comment you made that deposit growth will be a constraint on growth overall. How should we think about this? Like, do you think, these tight liquidity trends will ease over the coming months, or, are we talking about a challenged deposit growth kind of outlook, not just for Axis, but for the other banks as well? And then related to that, what are the actions you can take on the asset side to offset some of these pressures? Thank you.
So I think you spoke about LCR at 118, which is where we are on an average for the quarter. Typically, if you see over the last 18 quarters, we've bobbed between 115 and 120. That is where we're quite comfortable, especially given the outflow rates that we have been able to sort of significantly improve over the last 3 years or so. It is a tight liquidity environment. I mean, while the policy rates are at 6.5%, you can see that overnight rates are closer to 6.75, and much of the curve is at 7% and beyond. That is the liquidity situation that we are seeing at this point in time. It will require intervention from RBI, and I don't think that intervention is going to come anytime soon. And so therefore, the pressure on deposits will continue as we go forward, which is therefore the point that Puneet makes, that how much we will be able to grow will be determined by how much we are able to grow on the deposit side. You would have noticed that thanks to all the initiatives that we had put together over the last many quarters, sweating the franchise, partnerships, technology like Siddhi, etc., have helped us gain market share, and I think that is a play that we will hopefully continue to play as we go forward. On the asset side, I think we'll have to get a balance between continuing to build a long-term franchise with our customers on one side, and being able to optimize for NIMs and ROE on the other side. And I think that is a balancing act that we will have to continue to play based on how liquidity and therefore deposits for us grows in the coming few quarters.
Thank you. I was after the LCR retail deposit number, if you have that handy.
Chintan, we will anyway be publishing that number as part of our Basel disclosures. You should see it on our website at some point in time later in the evening, please.
Thank you so much.
Thank you. Next question is from the line of Mahrukh Adajania from Nuvama. Please go ahead.
Yeah, hi. I just wanted to check on bulk deposits. So the system liquidity got much tighter towards the end of the quarter. Would it be fair to assume that a lot of bulk deposits were mobilized towards the end of the quarter, and the full impact on cost will be seen on the next quarter? That's my first part on deposits. And my second part is on any comments on LDR, given that everyone seems to be worried about the LDR. Of course, you did mention about the deposit challenge. And then some banks have admitted to RBI having discussed this one-on-one with them. So where do you see your LDR settling, say, by FY25, given any broad range? I know you don't give specific guidance, but.
So Mahrukh, this is Neeraj here. On your question around the bulk deposit pricing, I think bulk deposit pricing continues to be inching up steadily through the quarter. It's not just a quarter-end phenomena, as the system liquidity has remained tight and the overnight rates have inched towards the upper end of the corridor. It is kind of getting reflected in where the bulk deposit rates are and where
the CD rates are, which are kind of very close to each other. I don't think this trend eases off anytime soon. In fact, Q4 being the last quarter of the year, we'll probably see this continuing. The main driver will be how the liquidity in the system plays out and how Reserve Bank sort of deals with the liquidity. So I think that the trend is kind of there. It will play out steadily over a period of time.
No, my question was that were most of your bulk deposits mobilized towards the end of the quarter?
We do it through the quarter, Maru. Our deposit mobilization process continues through the quarter. So there is no, in some senses, bunching up towards the end of the quarter as you're referring to.
Well, we have, Avinash, we moved away from this. We worked very hard to move away from this quarter end, month end stuff. So, maybe, it has happened in the system, but you will also notice that we are perhaps the only large private bank whose LDRs have moderated sequentially. And I think you should give us credit for that. Also, we continue to have one of the best outflow rates in the industry, which has been continued to be demonstrated even during this quarter. And as Neeraj very rightly pointed out, even on the LCR side, we have always operated within the 115 to 120 band. The movement is almost, has been within this band for last 18 quarters. So, talk about consistency in terms of how we have run the business and the liquidity coverage ratio through the cycle. So I think just please keep that in mind. We raised large deposits through the quarter, yes, at the right price, it makes sense to us, and we'll continue to move forward. But there is no quarter end effect. I just want to move away from that. Puneet, you want to add something here?
Maru, thank you for the question. I think the direct pointed answer to your question is, if you look at slide 8 of our investor presentation, you will see deposit growth presented on a QAB basis, and you will see that the QAB basis deposit growth tracks NED basis very closely, which will indicate to you that balances have grown through the quarter rather than at period end.
Perfect. And on just the LDR thing, I know that it's improved, so it's rare that in this quarter someone's LDR has improved, but any range you would like to give for FY25?
Maru, thank you for the question. We don't offer a range on LDR. We think there are multiple variables through which we manage our balance sheet. LDR is one of the variables. We do not have a targeted LDR that we discuss publicly.
Okay. Thank you so much. Thank you.
Thank you. Next question is from the line of Suresh from Macquarie Research. Please go ahead.
Yeah, hi. So two questions. One is on this deposit mobilization strategy itself, right? So, we were focusing a lot on retail deposits, but if I look at the same slide 8, it looks like almost 60% plus of incremental deposits this quarter has come from non-retail term deposits, right? Which has grown 12% QOQ. So should we read too much into this? It's just one quarter phenomenon where liquidity has been tight and therefore you have to take recourse to bulk deposits? Or how should we read into this? Because it's a large number, almost 60% incremental has come from NRTD.
Suresh, thank you for the question. Couple of things. I think while you look at slide 8, I will also request you to look at slide 9 and slide 8 collectively. On slide 9, you will see that our retail term deposits have grown by 17% on a year-on-year basis. And if you look at the trajectory of growth in retail deposits, it was close to 0 in December 22 and it's up to 17%. This is in line with all of the effort we are making to granularize the franchise, and the output of those efforts are visible in the RTD growth number. Yes, you're right that in the current quarter, NRTD has contributed to growth, but again, I think it is not a period end balance. It is coming from our corporate customers, and effectively, as Rajiv often says, we are a universal bank. We deal with retail customers and wholesale customers, and if the wholesale customers offer us an opportunity to pick up deposits from them, we'd be very happy to pick up deposits from them.
Suresh, I would add, you're asking a very fair question. I would add you to also think and take into account the outflow rates we have, right? So even if we are raising, let's say, deposits from our wholesale customers, please remember that they are coming at a certain outflow rate, which means that, they could, a decent portion would be non-callable. So it's not just, raising some short-term deposits. We're trying to ensure that the balance sheet is structured right on a consistent basis. So just keep that in mind.
The only problem, Amitabh, there is these deposits tend to be a bit more fickle in nature, right? If liquidity tightens, I know till the time it's non-callable, it's fine. But suddenly the corporate moves to another bank in the market, and there is a lot of bidding war happening by the PSUs in the market. So you're confident that this doesn't distort the pricing curve on the cost of fund side for you, right? Because you've gone ahead and raised a lot of bulk deposits this quarter. That's the only worry I have. Yeah.
So, look, pricing of the deposits is a market-driven phenomena. It is not just in the bulk deposit side, but even also on the retail deposit side, we are making sure that our liability cost is in line with what our peers are offering. So it is competitive on both the sides, not just on the bulk deposit side. Yes, bulk deposits tend to have a certain phenomena that needs to be taken into account, but I've seen a good correlation between where the bulk deposit rate go and where retail rates go over a period of time. The non-callable feature, which actually helps us make sure that the outflow rates are not high on bulk deposits, is the one real hedge against this deposit shopping in some senses.
Okay, clear. And just finally, one question on capital. I know you have, of course, repeated your stance, but still, again, for the benefit of everybody, you're at 13.7. Your peers, of course, are easily 200, 300 basis points above the number that you're reporting. Some of them actually, Amitabh and Puneet, they keep internal thresholds of 14% common equity tier 1 under the new Basel III regime. Whatever it is, each bank has its own threshold criteria. At 13.7, are you comfortable? You sure that, with the outlook which is there, and can you share anything with respect to your internal thresholds there? Any guidance on that would be great. Thank you.
Suresh, thank you for the question. I think the framework that we've consistently adopted with respect to capital is we think about capital on two pillars, capital for protection and capital for growth. Under the protection pillar, we look at regulatory capital as well as capital to protect domestic AAA. Even at 13.71, we carry sufficient cushion over both those variables. On capital for growth, I would just request you to look at what we put out on slide 16. On a 9-month period, FY24, we have net accreted 39 basis points of CET1 capital. We are currently in an environment where we think we will organically continue to accrete capital. Amitabh did indicate in his opening remarks that our house economist expects advances growth at an industry level to be at the 12-13% range. And therefore, we are really not seeing capital being consumed for growth given how our organic business is accreting. So we continue to maintain our position categorically that we do not intend to raise capital. I think to your question in reference to Basel III norms, the one request I would have is the risk weights under Basel III are very different from the regulatory risk weights. So what you're seeing as 13.71 basis regulatory risk weights would be different in the Basel III construct. Therefore, again, putting that layer onto your question, we still categorically maintain we do not need capital at the current stage and would not be raising.
Okay, thanks so much, Puneet.
Thank you. Next question is from the line of Pranav from Bernstein. Please go ahead.
Hey, thanks for taking the question. Just had a question on your loan mix. You've continued to move towards, the higher yielding segments. Two questions on that. One, with the risk weight change that has been announced, do you see a change in pace of that transition? Number one. And number two, do you have an end state in mind in terms of the split between mortgages and other consumer segments that you have right now?
So
consumer business, especially the personal loan business, has been growing. But if you see slide 22, in terms of retail disbursement trend, quarter on quarter, that number in terms of composition is down to 22% from 25% in the previous quarter, which really means that the other assets also are growing. So we are kind of comfortable with that. As we earlier also said, we don't see any stress in the portfolio. The growth we see on the consumer loan side is a result of a few quarter effort in terms of transformation projects being run and a lot of partnerships scaling up. So that we intend to continue. The loan mix is in a desired state as we are progressing. Can you just repeat the second part of the question?
Second part is more on a steady state mix that you're looking at. Are you at the steady state, or is there some more transition that you expect to happen?
Yeah, so we have been around 78, 80 secured, 20, 22 unsecured. That's what we've been saying and holding for some period of time. If it goes to 75, 25 over a period of time, that also is fine with us. It's something which we have to keep moderating and observing in line with the various developments happening in the industry. And currently 75% of our retail book is secured. So
my question was more related to the mortgage growth. I think we've seen almost for several quarters now that growth has been muted. So was wondering if that was part of an intentional shift to get to a certain loan yield, and therefore if we should expect a recovery in the mortgage growth, or if we'll see some more of this loan mix shift happening.
I think I mentioned it in the previous call also that we are assessing every business based on risk-adjusted return on capital, and these asset classes stack up on that RAROC curve in a certain way, and whichever is higher on the RAROC curve, within obviously defined limits, we will try to push that business more in comparison to the others. It's not that the mortgage business is not important for us, it's a large business for us, but in a deposit-constrained environment, we will obviously have a waterfall, and in that waterfall, we will push businesses which give us a better return. So we don't want to get caught up in, specific numbers in each of the businesses, but we will play depending on what makes the, most optimal sense for us. And in a deposit-constrained environment where credit growth will get constrained, a lot of questions around LDR and so on and so forth, I think we need to prioritize where we want to grow, and that's exactly what we're doing.
Understood. Perfect. Thanks a lot.
Thank you. Next question is from the line of Jay Mundra from ICICI Securities. Please go ahead.
Yeah, hi, good evening, and thanks for the opportunity. Sir, on your opening remarks, you mentioned that the systemic deposits and credit growth are likely to converge at around 13%. Is this like FY24 or this is like FY25? So any timeline for that number?
I mean, if you look at all the commentary coming from RBI and the governor and commentary around inflation, I think it is quite obvious that this is not just next 3 months event. This will continue into financial year 25, and I think stay during financial 25 for almost the entire year, unless something dramatic happens. We are still way off from, or at least away from the target which RBI has in mind on inflation. There are still risks to that inflation target. So I do not see interest rates coming down. I do not see RBI, taking the pedal off the constraining the liquidity. And frankly, the biggest factor which is driving the why the deposit rates are high or deposit growth is constrained is RBI tightening the liquidity, and I don't see that going away. So, cutting long story short, we do expect the deposit growth to remain constrained, and as a result, over a period of time, the credit growth has to temper down. They have to converge at some stage. They can't keep running in two different or at very different levels for a long period of time. And this is not what we've been saying today. We have been saying this for quite some time also, quite consistently.
Right. Right. So, sir, in that context, at our current LDR, while it has improved quarter on quarter, it goes without saying that the ask rate on deposit for Axis Bank is much higher than the credit growth rate, right? That is how, and you also indirectly mentioned that the deposit growth could be a constraint for the credit growth, at least in the near term. Is that the right interpretation?
So one of the drivers of the LDR change over a period of time is how we've optimized our balance sheet. If you see, our outflow rate on deposit has come down from roughly 26% to 21% now. And that has meant that we have preferred certain kinds of deposits over certain other kinds of deposits, right? The deposits which attract 100% outflow, we've preferred not to increase that book or rather shrunk part of that book. And that has had an impact on LDR. So, like we said, that LCR, LDR, NSFR, these are all important parameters that we look at while optimizing a balance sheet and seeing how the balance sheet evolves over a period of time. All of these are important parameters, but at times, there is a play between one versus the other.
And a last, a different question on, notice that you have around 10 million non-Axis Bank customers using Axis Mobile and Axis Pay. And I assume these are not free charge customers, right? Because that runs into millions or even higher numbers. So if you can provide some color as to what exactly is the offering that these non-Axis Bank customers are using, and any medium-term plans to convert these known-to-bank customers to offer other services or cross-sell.
So you're right, these are not free charge customers. There could be some overlap, but in general, these are not free charge customers. We have been speaking about three types of customers: new to bank customers, existing to bank customers, and known to bank customers, customers that we know something about. So this set of customers are customers where we know something about them, and we have various programs where we are able to underwrite these customers, and we are able to sell personal loans, credit cards, etc. to these entities. We are a leading player on the account aggregator platform. Much of the traction that you are seeing is through this route as well, and of course through the various UPI platforms that we are present on.
Understood. Thank you and all the best.
Thank you. Next question is from the line of Rikin Shah from IIFL. Please go ahead.
Thank you for the opportunity. I have two questions. First one is on the linking of the loan book to different benchmarks. So we see that the repo loan benchmarking, the loans linked to the repo loans are up by almost 10 percentage point in last 1 year to almost 48-49%. That is in the context of mortgage loan growth being slower. So just wanted to understand what's driving this change in the context of impending rate cut cycle that we may see. That's question one. And second, just a small observation, the cost guidance has been removed from the presentation. So do we need to read anything onto this or anything you would like to elaborate? Thanks.
Thank you for the question, Rikin. I'll take the second question first. We commented on cost on the analyst day, and the comment that we made on cost at the analyst day, which we continue to carry since then, is as long as the benign credit environment allows us to continue to invest in the franchise, we will continue to invest in the franchise. We are investing for the future. We are investing to build capabilities. Some of the investments are visible to you today. The Neo app, the mobile app, the tech stack that we have built, the 350 branches that we've created. So as long as we operate within a given due point, we will continue to make the investment. We remain focused on managing our expenses when the need arises, and we do believe that we can pull back that expense if the need were to so arise. So I don't think there is that number that we used to put out was taken away when we discussed at length the bank's performance at the analyst day. It's not a takeaway in the current quarter commentary. Sorry, Rikin, can you give me context to your first question, please?
Yeah, so we look at the loan book being benchmarked to different rates, and there the loans which are benchmarked with the repo rate, the share of those loans have increased by almost 10 percentage point from 38-39 to 48% now to the repo link. So given the impending rate cut cycle, first I wanted to understand as to what's driving this higher increase in the benchmarking to the repo? And second, does this mean that once the repo rate cut cycle kind of begins, the transmission of interest rate yields will now be faster, or would you kind of course correct before that?
Firstly, we are not in the impending rate cut camp. So let me get that out of the way first. I think, as you know, that all of retail or much of retail and almost all of SME is repo linked, and therefore as that book grows, it continues to be repo linked. Over the last 1 year, we've also seen increasing use of repo rate on the corporate side for corporate loans, and that is driving that growth as well. So therefore, it is most of retail, almost all of corporate, all of SME, and some part of the corporate side, which is now repo linked.
Understood. Fair enough. Thank you very much.
Sorry, Rikin, I'll just supplement what Rajiv said. If you look at our December 22 presentation, 68% of our loans were floating rate. As at December 23, it's 69%, which is floating rate. So there isn't actually a movement. It's just a play between the benchmark types. And effectively, over a finite period of time, the benchmarks will have to behave similarly across a rate cycle.
Sure. Thank you, Puneet.
Thank you. Next question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. Hi. Thanks for taking the question. So I'm not sure if you answered that because I missed some part of the conversation. But given that you always have been highlighting in terms of the growth targets, but now it seems to suggest that deposit is definitely a constraint. So would we still continue to grow at 4 to 6 percentage points higher than the system average when you are highlighting that loan and deposit growth would settle at 13%? Or does that also change given this CD ratio as well as the deposit constraint which is there?
Boss, you're trying to hold us quarter on quarter. I think we continue to maintain our guidance that in the medium term we'll continue to be able to maintain that 400 to 600 basis point differential. We're not changing that.
Sorry?
We have said that we'll maintain the 400 to 600 basis points differential between industry and our growth rate. Don't hold us quarter to quarter, but yes, in the medium term, we believe that we can maintain it and we are not changing it.
Okay. And secondly, in terms of maybe earlier we highlighted last quarter that almost like the marginal cost of funds and cost of deposits have stabilized. So where are we in terms of maybe what would be the gap between the incremental cost of deposits and the outstanding cost of deposits? If you can maybe not give the exact numbers, but how much is the gap left between the two, which will get caught up over a period, yeah.
Kunal, thank you for the question.
Particularly term deposits, yeah.
Kunal, thank you for the question. What we've maintained is marginal cost of funding has stabilized. As long as the marginal cost of funding remains at where it has been for the last 4 to 6 months, we do expect our base deposit book to get repriced through quarter 4 and quarter 1 of the current financial year and a spillover into quarter 1 of the next financial year.
Okay, got that. And any levers on the loan book side now available given that unsecured pie is also coming up? Though this quarter we see sequential growth being strong in some of the high yielding segments. Plus now RIDF is also down to almost like say 1.8 odd %, almost getting in line with or maybe much below where the other banks are. So maybe there were a couple of levers on the yield side. But what levers do we see now going forward on yields?
Thank you, Kunal, for that question. I think if you look at slide 12 of our presentation, from a mix perspective, we've talked about retail SME as a percentage of loan book. We've talked about the INR, non-INR book. And those are the two observations that you're pointing out have gotten to the 69% and the 4.2% respectively. We also flagged off a third lever when we speak about our yield optimization journey, which is sub-segment shift within the wholesale business, which is still to play through. The other element is that if you look at our bank balance sheet, only about 14 to 15% of our advances are unsecured. So we do still have some play at a full bank level between secured and unsecured exposure as we move forward. So short answer to your question, yes, there are some levers that have been optimized, but there are other levers that we can still work through in the coming quarters and coming years.
Okay, perfect. Yeah, thank you and all the best.
Thank you. Next question is from the line of Saurabh Kumar from JP Morgan. Please go ahead.
Hi, sir. Just one question. Sir, on this wholesale credit side, so you've had a large recovery. So two things. One, can you help us with what is the quantum of the on the written off book? What is the quantum left, and how long would you expect this negative credit cycle? I mean, the recovery cycle in the corporate to last, negative net slippage in the corporate to last. Thank you.
Saurabh, thank you for your question. I think if you looked at slide 62 of our investor presentation, you will see a table that gives you the cumulative value of prudential write-offs till date. The number at Q3 FY24 is 40,211 crores. Please appreciate that this is a value over. Sorry?
Of this, how much will be corporate?
We don't break this up between corporate and retail, but if I just give you context, 40,211 crores, this is cumulative value. We have been recovering against this value over a period of time. I think to your specific question on data point on what is corporate and what is corporate recovery likely to be, we have directionally commented to say that we do expect credit costs to move up. In the first stage, recovery from written off accounts will reduce, and over a period of time, we do expect credit costs to move up for the system and for us. All of us are operating below long-term through cyclical credit cost numbers. Hence, that's the trajectory that we expect to see over time.
Okay. Okay. All right. Thank you.
Thank you. Next question is from the line of Param Subramanian from Nomura. Please go ahead.
Yeah, hi. Thanks for the opportunity. My question again is on deposits. So historically, we've pointed out in the past that we are strong in the government business, and one of the reasons for the tighter liquidity is government money going out of the system. So when that money comes back, are we better placed compared to the rest of the system? Any sort of gearing you'd like to highlight over there? Yeah, that's my first question.
So you're right. Historically, we've had a strong relationship with the government at the central, state government, district, panchayats, right down to the beneficiaries. And we continue to leverage on those relationships. Increasingly, what the government wants is technology solutioning to be able to manage this flow from the Consolidated Fund of India all the way down to the beneficiary. And we've been providing to the various governments, various state governments, various departments of and ministries these solutions, and we have a significant market share among private sector banks as far as government business is concerned. The government is looking to get more efficient in terms of these cash flows. So in the long term, I think as much of these flows become more and more digital, the amount of float in the system will reduce. But I think that is not a problem that we will have tomorrow. But over a period of time, it could potentially sort of play out. But I think the point that you are making is that there is money lying with the government, and therefore there's liquidity tightening. I think to some degree the way that the government, the RBI thinks about liquidity is the liquidity pool that is lying in the banking system. The money that is lying with the government, because that government money will either come through in terms of salary payments at the beginning of every month, or payments to the state governments and for infrastructure spends, etc. So there is a bit of a lead lag as GST payments go to the government and some of these payments come through. I think, one of the things that's been happening is revenue numbers for the government have been very strong. And so therefore their liquidity build-up has been quite strong. I do believe that, maybe for the next couple of months, as the code of conduct for the elections, which have now pretty much been announced for April 16th, begins to kick in, there may be some slowdown in terms of government spending, but all that will come through as we go forward.
Perfect. That's really helpful. But could you provide any, say, numbers in terms of market share? You did highlight that you have a significant market share, but market share or say percentage of your total deposits, say, contributed by the government business?
Sorry, can you market share?
Any numbers on the market share? You highlighted your market share in government deposits is higher. So any numbers you can give over there? Yeah.
We don't have. One of the problems that you will always face is that there is no public data around this. So we know some of these numbers because of some of the work that we've done and some anecdotally. So not comfortable sharing that number.
Okay, no problem. And my other question is on repricing. So what are the price actions we have taken on unsecured retail and as well as loans to NBFCs, post the RBI increase in risk weight? Yeah, those were my questions. Thank you.
Thank you for your question, Param. I think on incremental disbursements, we have increased pricing on personal loans. Obviously, you would appreciate that it is a competitive market space, and therefore how much you can pass through to the customer depends on market conditions. But we have increased pricing on the loans, and we are seeing a better yield come through on our PL portfolio on incremental disbursements. The back book is entirely fixed, so we're not likely to see that reprice till it gets repaid. On NBFCs, we are in the process of passing on the rate hike to the NBFCs. It's a function of when the loan is due for repricing. But we have seen a marginal uptick in gross yields on our NBFC book this quarter compared to the last quarter.
Perfect. Thanks, Puneet. Just one more question, if I can squeeze in. So, did I catch it correctly that you are not going to be held to the 2.1% cost to assets exit ratio that you are guiding to, say, by end of FY25? So that is not something we are looking at currently, is it?
Param, what I said is, if the environment permits us to invest, we would like to invest for the future. That's what I had said when we did our analyst day. Given the benign credit environment, we would like to continue to build the franchise for the future, as long as we can deliver in and around our aspirational ROE metric.
Okay, got it, Puneet. Thanks a lot. All the best to the team. Thank you.
Thank you. A request to all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. Next question is from the line of Samir Bhise from JM Financial. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just thinking around this liquidity tightness, wanted to get thoughts from Amitabh on how do you think from the second order derivative perspective of this phenomenon? Would you worry on potential asset quality issues? Are we still some time away from that? And what would you see as signals if it kind of persists for a longer time?
Well, it's difficult to predict at this stage. I think if given where the Indian banking system is, where the consumer sentiment is, yes, and the way the regulator is watching the matrices so closely and so actively, I do not see the second order impact coming through, in any big or significant way. But, ultimately, we are in the risk-taking business, and it's very difficult to say anything with surety. I mean, all of us are watching our numbers very, very closely. All of us are aware that the times are so good that we do need to watch our numbers closely, because this is when we might be making some mistakes. No signs as yet. But this potential, tightening situation, pricing might lead to a second order impact? Only time will tell. I can only assure you, at least from Axis Bank perspective, We are looking at everything possible we can very, very closely and trying to assess if there is any signal out there which could be telling us that things could be going down, like going south in some form or shape.
But at this point in time, you don't worry on that front. Is that
Boss,
fair?
this taking business, I'm worried all the time.
Right. And just quickly, can I have a breakup of the gross slippages across businesses?
Thanks for the question. Our gross slippages for the quarter were 3,715 crores. They declined 2% year-on-year. Segmentally, it was 3,384 crores for retail, 238 crores for CBG, and 93 crores for the WBCG business.
Okay. This is helpful. Thank you and all the best.
Thank you. Next question is from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi. Thanks for taking my question and congrats on the quarter. And I don't mean to harp on this too much. It's been discussed quite a bit. But if you had to reduce your LCR, just want to understand management's approach. Would you rather slow down loan growth or get the required deposits through NRTD and compromise a bit on NIMs?
Thank you for the question, Piran. I don't think there is one answer to that question. It is not a choice of either or. It will be a mix of both that we will work through. We can't really say that we are willing to pay any price for a deposit to fund our loan growth. And similarly, we are not saying that if deposits are far too expensive, we will not grow at all. We operate in a model where we will optimize both variables. So the honest answer is there will be a path that we will find to grow with deposit cost increases as they move through in the future.
Got it. So in the interim, it is fair to assume that there is a chance your loan growth does not grow 4 to 6 percentage points higher than the industry in the interim. That's a fair assessment, right?
Piran, I think the request I have of you is the 400 to 600 guidance that we had was basis the structural strength of the franchise, and we said that that's the number that we will target in the medium to long term. We did not hold ourselves ever accountable to do that number on every sequential quarter basis. The comment that we've added through this call is given where liquidity is in the market today, we do expect deposits to constrain advances growth. We will operate within both those metrics, but we are not moving away from our medium-term guidance of 400 to 600 basis points faster than industry credit.
Got it. And just secondly, can you talk a bit about what has changed in LAP? Like until 2 quarters back, we were barely growing 1-2% QOQ. Now it's picked up to 6-8%. So maybe if you could just help us understand what changes you've made to drive growth here.
So again, LAP growth is an outcome of some of the transformational projects which we have been running. During the last 12 months also, LAP was outgrowing within the mortgages business. This year we've seen a lot of stuff come together in terms of delivering the growth which we are seeing. Portfolio quality remains strong, so we expect this growth to continue.
So we've like improved the turnaround times, done more. Something would have changed that we
But we can't hear you clearly.
Oh, sorry. I meant have we improved, like say, our turnaround time? Have we added distribution, a new partner? Something would have changed that it picks up pretty smart.
So it's a mix of everything. We've added partners, turnaround time has improved, our channel management has gotten stronger, sourcing from branch has increased, we've gotten deeper distribution into our rural Bharat banking branches. So it's a host of initiatives across the board which we've been working on, and that's what has resulted into this outcome.
Got it. Okay, that's useful. Thanks and all the best.
Thank you. Next question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Good evening, sir. Thank you for the opportunity. Got a couple of questions on the credit card piece, which is on slide number 22. So when we say that 52% is ETB and 33% is known to bank, this entire 33% known to bank is coming from the Flipkart co-brand. That's the first part that I wanted to understand. And also the definition of known to bank. The second part is what is the mix of revolvers, EMI, and personal loans here in the and transactors here in the mix, and what would be the ballpark ROA that we make on a steady state basis in this business, in the credit card business? Thanks.
Yeah, sure. Thanks for your question. This is Arjun here. So I'll try and cover all of it. KTB refers to known to bank, which is a set of customers where we have some information about them, but it's not exactly a customer who has an existing some other product of the bank. May not be a SA account, may not be a loan, but they do in many cases come from our partners where we have compliant data sharing arrangements which allow us to get a better insight about that customer. No, all of them do not come from Flipkart. We have a similar arrangement with multiple partners. As you know, we've got partnerships with Airtel, we've got partnerships with Samsung, we've got partnerships with Google, and also Flipkart. So it's a mix of partners. We do not share, unfortunately, portfolio-specific and segment-specific metrics at the third level, such as EMI and revolve rate. But suffice it to say that the broad trends we have seen in the past continue to hold out this quarter as well. Not sure I can say much more than that. Your third question I couldn't quite catch. Would you mind repeating that, please?
What would be the ballpark ROA of the credit card business on a steady state business? Steady state business, not like in this quarter or quarter gone by.
Yeah, no, that unfortunately is something we can't share at the product level. But we do track it, but we can't share it at the product level. I'm sorry.
Right. If I can just, in that case, just even one last question. What would be absolute dollar value of the cost of acquisition for existing to bank, a known to bank, and an absolute open source customer?
This is a product-wise, segment-wise question, and again, we can't share that level of granularity in terms of the metrics.
No issues, sir. Best of luck.
Ladies and gentlemen, we will take that as the last question. I will now hand the conference over to Mr. Puneet Sharma for closing comments.
Thank you, Nirav. Thank you, everyone, for taking the time this evening to join us. If there are any questions that remain unanswered or there are follow-on questions, please feel free to reach out to Abhijit and our IR team, and we'd be happy to pick them up. Thank you and have a good evening.
Thank you very much. On behalf of Axis Bank, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.